Hey everyone, welcome to The Explainer. So today we're diving into a topic that's absolutely covered in hype, mystery, and, let's be honest, a whole lot of Hollywood romance. Yep, we're talking about day trading. But look, we're going to totally strip away that cinematic drama today and get right down to the actual gritty mechanics of what it really takes to survive in this super fast-paced arena. We're basing this explainer on the essential blueprint for successful intraday trading. And the goal here is pretty simple. We want to completely demystify this world for you.
Okay, let's dive into this. Here is our roadmap for today. First, what is intraday trading? Second, the trader's vocabulary. Third, the daily trading routine. Fourth, strategies of the trade. Fifth, the golden rules of risk. And finally, number 6, the brutal reality. I promise you, we're breaking this big, intimidating topic down into a really clear, highly organized blueprint.
All right, moving right along to Section 1. What is intraday trading?
To kick things off, I want you to completely forget about complex stock charts, flashing red and green numbers, and all that Wall Street jargon for just a second. Let's bring this right down to the absolute basics. Imagine walking into your local farmer's market. You see a massive crowd, right? So you buy a box of fresh apples at 9:30 a.m. for $10. Just 45 minutes later at 10:15 a.m., you turn around and sell that exact same box to someone else for $12. So by the time you head home, you've got absolutely zero apples left in your hands, but you do have an extra $2 in your pocket. That is literally the core concept we're dealing with here, ending your day with zero inventory, but extra cash.
And you know, that apple analogy directly translates into our financial definition. Intraday trading, which is commonly just called day trading, is the practice of buying and selling financial instruments, like stocks, currencies, or commodities, within the exact same trading day. So instead of waiting years for a company to grow, you're looking to capture these tiny micro-movements over just minutes or hours. And here is the absolute golden rule. Every single trade has to be closed before the closing bell. You never ever hold any investments overnight. Let's move to Section 2 and see how this builds. Section 2, the trader's vocabulary.
Before we get to the real action, we need to do a quick inventory check on the language traders use. Let's do a rapid-fire jargon-busting session. First up is position. Let's just toss out the textbook definitions here. A position simply means you're actively in a trade. If you buy 100 shares of Microsoft, you have an open position. Once you sell them, your position is closed. Boom. Simple as that.
Next is square off. Now this is trade lingo for making sure your desk is completely clean before you go home. It means you are manually closing all your active trades before the market shuts down for the day. And I really cannot stress the importance of this enough. If you forget to square off manually, your broker's automated system's going to step in, do it for you, and they'll usually slap you with an extra fee for the trouble.
Then we have liquidity. Think back to our crowded Apple market from earlier. A highly liquid stock, like Apple or Tesla, has millions of buyers and sellers active at any given second. High liquidity is absolutely crucial because it guarantees you can jump in and out of trades instantly. You definitely never want to get stuck holding a stock just because nobody's around to buy it from you.
And right alongside liquidity, we have volatility. Volatility is basically how fast and how drastically a stock's price bounces around. Think of it like a wild roller coaster. It's highly risky for sure, but it's absolutely essential for day traders. If a stock moves like a turtle with super low volatility, you just can't extract those quick profits in a few hours. You need that movement.
Now, what's really interesting about this next concept is how these two fundamental actions contrast. Going long is the traditional way, right? You buy low and you sell high later. But going short, or short selling, is totally counterintuitive. It actually allows you to make money when a stock's price goes down. How is that even possible? Well, your broker lends you shares. You sell those borrowed shares immediately at a high price, let's say $50. Later, when the price inevitably drops to $40, you buy them back, return them to the broker, and you pocket that $10 difference. So you sell high first and buy low later. Pretty wild, right?
All right, Section 3, the daily trading routine.
With our vocabulary locked in, let's look at the chronological backbone of intraday trading. Because listen, this is a highly structural profession that requires immense, unwavering discipline. Skipping steps here is just the fastest way to lose money. Let's literally walk through a day in the life. At 8 a.m., before the market even opens, you're doing your pre-market analysis. Checking global news, earnings reports, and building a tight watch list of maybe 3 to 5 volatile stocks. Then at 9:30 a.m., the opening bell rings. Those first 2 hours, that's the most volatile and profitable time. You execute your setups and you immediately attach your risk protection. Fast forward to 11:30 a.m., we hit the midday assessment. The market generally slows down during lunch, so you track your positions, but you don't force any new trades. Finally, from 2 p.m. up to that strict 4 p.m. deadline, it's closing squaring off time. Volume picks back up, and your sole focus is just exiting every single remaining trade before that bell rings.
Moving right along to Section 4, Strategies of the Trade.
Okay, so we know the schedule, but what exactly are these traders doing during those execution windows? Well, professionals definitely aren't just guessing where a stock is going. They rely on tested visual frameworks. Here are 3 of the most popular strategies. First, momentum trading. This is exactly what it sounds like. You find a stock that's moving aggressively on big news, you hitch a ride on that fast-moving train, and you jump off the exact moment it slows down. Second is scalping. Now this is a hyperactive strategy. We're talking dozens or hundreds of trades a day, holding stocks for literally seconds just to snatch up tiny penny profits that eventually add up. And third, reversal trading. This one's kind of contrarian. You look for a stock that's moved way too far, way too fast, and is totally exhausted. You enter the trade basically betting the price is about to snap back in the opposite direction, kind of like a stretched rubber band.
Which brings us to Section 5, the Golden Rules of Risk.
Now, I need to shift gears for a second and adopt a slightly more serious tone. Because while everything we've talked about so far is super exciting, we absolutely have to discuss the necessity of risk management. This is literally the exact line that separates the seasoned pros from the gamblers. So the crucial point is this simple number, 1%. The 1% rule states that you should never, ever risk more than 1% of your total trading account balance on a single trade. Think about it. If you have a $10,000 account, your maximum loss on any single trade cannot exceed $100. Why? Because day trading pretty much guarantees you're going to face losing streaks. Sticking rigidly to this 1% rule ensures your survival during those runs of bad luck, basically keeping you in the game.
And to enforce that 1% rule, the pros don't just rely on willpower, they use automated tools. A stop-loss order is basically your automatic financial emergency brake. Say you buy a stock at $50, you set a stop-loss at $49. If the stock suddenly crashes, your platform automatically sells it at $49, capping your losses. On the flip side, we have the take-profit order. This one automatically locks in your gains when the stock hits your upward target. And this is huge because it physically stops greed from talking you into holding a winning trade for way too long until it eventually reverses into a loss.
Finally, let's look at Section 6, the brutal reality. So we've seen the mechanics, the routine, the strategies, and those crucial risk rules. But now, it's time for a bit of a reality check. We have to weigh the exciting potential of day trading against the incredibly harsh statistics of the profession itself. Let's look impartially at the pros and cons here. On one hand, the advantages are incredibly appealing. You've got zero overnight risk, meaning you can sleep soundly knowing your money is in cash, totally immune to midnight news drops. You also get immediate returns. You know your exact profit or loss by dinner time. And thanks to short selling, you can profit in pretty much any market direction. But we have to look at the disadvantages. Staring at prices ticking second by second causes extreme emotional stress and some serious mental fatigue. Plus, because you're trading so actively, high transaction costs, broker fees, and taxes really start to eat into your returns. And perhaps most sobering of all, there is a massive learning curve here that is heavily stacked against newcomers.
Which brings us to the final point. The statistics show a really harsh truth. Over 90% of retail day traders actually lose money in their first year. The primary culprits? A total lack of discipline and poor risk management. Intraday trading is definitely not a get-rich-quick scheme. It's a highly demanding, full-time job. So I'm going to leave you with this question to really reflect on. Knowing the immense psychological weight and the rigorous risk management this requires, do you have the emotional control required to be the 10% that actually survive? Thank you so much for joining me on The Explainer today, and keep learning.